It is Sunday night, and the world that closed on Friday does not exist anymore. Missiles have already crossed borders. Drones have already hit targets. Oil tankers are already turning away from the Strait of Hormuz. And while most investors are still waiting for markets to open, one metal has already moved. Silver is not waiting for Wall Street. Silver has exploded. If you think this is just another headline that will fade by Monday morning, you need to stay with me. Because what just happened between Iran, the United States, and Israel is not a normal geopolitical flare-up. This is the kind of trigger event that forces money to move fast. And when money moves fast into a small market like silver, the price does not climb gently. It gaps, it dislocates, it shocks people. Before we go any further, take 2 seconds right now to hit like and subscribe. On this channel, Past and Profit, we connect global events to real financial consequences before the mainstream catches up. If you care about protecting your money and understanding what is really happening behind the headlines, make sure you are part of this community. When coordinated strikes hit Iranian military infrastructure, the immediate focus was obvious: escalation risk. Iran controls territory that borders the Strait of Hormuz, the narrow waterway that carries roughly 20% of the world's daily oil supply. The moment that shipping lane becomes unstable, the entire global economy feels it. Energy prices react first, then transportation, then food, then everything else. Now, think about the environment we were already in before the first missile was launched. Inflation had cooled, but it was still sticky. Government debt in the United States is above $34 trillion. Interest payments alone are crushing federal budgets. Central banks do not have unlimited flexibility anymore. They are trapped between fighting inflation and preventing a financial crisis. When war risk hits an already fragile system, capital looks for safety. Not safety in theory. Safety that has survived wars, currency collapses, debt crises, and political mistakes for thousands of years. Gold is the first stop. But silver is where things can get explosive. Silver is not just a monetary metal. It is also an industrial metal. It is used in solar panels, electronics, medical devices, electric vehicles. That means its supply chain is tight even during normal times. When fear hits and investors rush in at the same time, manufacturers still need physical supply. You get pressure from two sides. That is exactly what we are seeing right now. As markets closed on Friday, silver was already trading at elevated levels. But over the weekend, while traditional exchanges were dark, physical dealers in Asia began adjusting prices higher. Not because of hype, not because of social media, because real buyers were stepping in. Here is something most people do not understand. When a geopolitical shock happens during market hours, investors can react immediately. They can log in, they can place trades, they can hedge. But when it happens over a weekend, something very different takes place. Demand builds behind a closed gate. Portfolio managers go home Friday with one price on their screen. Then war breaks out. They cannot act. They watch oil spike in after-hours markets. They see headlines about retaliation. They read reports about drones and missile defense systems activating across the region. And they know when markets open, they will need more exposure to safe haven assets. By the time futures markets reopen, buy orders are not trickling in one by one. They are stacked, layered, reinforced by 48 hours of fear and analysis. And silver, because of its relatively small market size compared to gold, can move dramatically when that wave hits. When silver rallies quickly, traders who were betting against it get squeezed. If the price jumps high enough, they are forced to buy to close their positions. That forced buying pushes the price even higher, which forces more shorts to cover. It becomes mechanical, it becomes violent, it becomes a chain reaction. We have seen this before in smaller bursts, but the difference now is scale. The Iran war risk is not a minor regional story. It sits on top of global energy infrastructure. It sits on top of an already stressed financial system. It sits on top of record government debt and fragile supply chains. Silver supply was already tight before this conflict. Mining output has not kept pace with industrial demand. Inventories on major exchanges have been trending lower over the past few years. Governments around the world have been quietly increasing gold reserves, signaling a lack of trust in fiat currencies. When gold demand rises, silver almost always follows, but with higher volatility. So when you hear silver explosion, understand that it is not just a reaction to one weekend. It is a spark landing on dry fuel that has been building for years. If tensions cool quickly, silver may pull back from its spike, but the floor will likely be higher than it was before the strikes. Why? Because investors have now been reminded how fast stability can disappear. Risk premiums do not vanish overnight once they are repriced. If escalation continues, if Iran targets energy infrastructure, or if the Strait of Hormuz faces real disruption, oil prices could surge sharply. Higher oil feeds inflation. Higher inflation reduces the real value of paper currency. And in that environment, precious metals do not just hold value, they reprice. In a more extreme scenario, where regional conflict widens and global powers are drawn deeper into direct confrontation, safe haven demand could accelerate beyond what most analysts are currently projecting. In that case, silver does not just test previous highs, it breaks into new territory. Now I want to pause and speak directly to two groups of people. First, those holding physical silver. Coins, bars, metal in your possession. You did not buy it because you wanted war. You bought it because you understood that the financial system runs on confidence, and confidence can break quickly. This weekend is a reminder of why diversification into hard assets matters. Second, those holding only paper exposure. ETFs, mining stocks, futures contracts. There is nothing inherently wrong with those instruments. But understand the difference. Paper markets can close. Brokers can halt trading. Spreads can widen. Physical metal does not depend on a trading app being open. That distinction becomes very real during moments like this. At Past and Profit, our goal is not to scare you. It is to help you see the connection between global events and your portfolio before the move is obvious. By the time silver is leading every financial news segment, the easy part of the move is usually over. The reason retention matters in a video like this is because the story is still developing. We are watching history in real time. Military decisions are being made as you listen to this. Oil tankers are adjusting routes. Central banks are monitoring currency markets. Hedge funds are preparing orders. And somewhere right now, traders are recalculating silver targets based on risk models that were completely different 72 hours ago. The probability of higher volatility has increased. The probability of inflation pressure has increased. The probability that central banks will have to choose between economic stability and currency stability has increased. Here is what I want you to think about tonight. If markets open and silver gaps higher, will you chase it emotionally, or will you stick to a plan? If it pulls back after an initial spike, will you panic, or will you recognize that volatility is normal during structural shifts? The biggest mistakes investors make during geopolitical crises are emotional, not analytical. They either freeze or they overreact. The disciplined ones understand their risk tolerance, their time horizon, and their allocation strategy before the chaos begins. We are entering a week where headlines will move prices intraday. Social media will amplify rumors. Analysts will debate escalation probabilities. Through all of that noise, remember the core principle. Metals respond to uncertainty and currency risk. Both just increased. As we wrap up, I want to hear from you. Do you believe this Iran conflict will be contained quickly, or do you think it marks the beginning of a larger regional shift? And more importantly, are you positioned for higher volatility in silver, or are you watching from the sidelines? Drop your thoughts in the comments. I read them, and they help shape future discussions here on Past and Profit. If you found this breakdown valuable, share this video with someone who needs to understand what is happening beyond the headlines. The more informed our community is, the stronger we become together. The world changed this weekend. Silver reacted first. Now we wait to see how the rest of the financial system catches up. Stay sharp, stay prepared, and I will see you in the next update.